Well, good evening. It's Friday, November 13th, Friday the 13th. I'm not very superstitious, but I know some people are. So Friday the 13th tend to be interesting days. I think I saw a cartoon about a cat and a ladder and a broken mirror and some other things that tend to be bad luck or superstitious. So hopefully that's not the case for our recording today. At any rate, we're going to be taking a look at Need to Know 12-5, which is a comprehensive cash flow statement problem. Again, it's in your book. It's on page 468 to 469. And these need to knows are really important in terms of as you move through these chapters. And for those of you that are going to be taking Principles of Accounting 2, again, same book, same chapter, ideas that these need to knows will continue. And they are critical as a study tool to help you understand the material that's being presented in the chapter. Because the way the courses are being presented to you, at least the way I do it, is that I have you do the work in the chapter first, and then we would come together and discuss the material and kind of clean up those areas that maybe you didn't quite understand or quite get as you read through the chapter, took your notes, and kind of worked through the different assignments. And so this is in preparation for the final exam. I want to make sure that everybody is knowledgeable about the statement of cash flows. And this one here is going to look at both the indirect and the direct method of preparing them. Of course, the information they've given us here is they've given us comparative balance sheets for this company, and they've given us an income statement. So we've got an income statement for the year ended December 31st, 2019. And on that same date, December 31st, 2019, and then for 2018, we have the balance sheet with all of the figures. Now, the important thing here is that the reason why you have two balance sheets is that this is a period statement. The income statement is a period statement. These are static statements at a point in time. So this is like a photograph. This here is like a video, recording of the whole year. And so this here, in order to equate the amounts in the balance sheet to amounts in the income statement, you need to be looking at the changes in the account balances over the course of time. And of course, those changes are going to be driven by additions or deletions from each of these account totals. So what else do they give us? Well, they give us some additional information. The first one here, A, equipment costing $21,375 with accumulated depreciation of $11,100 is sold for cash. B, equipment purchases are for cash. Why is that significant? Well, both of those pieces of information are important. One is you're going to be trying to understand why equipment has changed from $146,700 to $135,825. Remember, the purpose of the statement of cash flows is to identify the changes in cash that occurred from one period to the next. So we see we had a cash balance of $23,925 at the end of 2018. And at the end of 2019, that cash balance has increased to $43,050. And so we want to be able to answer the question is, why did cash change? Where did cash come from? And where did it go? And we typically look at it in terms of three categories or classifications for changes in cash. The first is operational. So we look at things related to the sale of our goods. So things related to getting the items into finished goods inventory to sell, and then what happens to them as we sell them. And so that's one of the three classifications. The second classification is the investing classification. Investing classification tends to deal with the long-term assets in the company. So our equipment, and if we had investment accounts because we were holding cash and we were investing it for the long term because we didn't need it in the current term, those would be the type of transactions we would see impacting the investing section of the cash flow statement. And then finally, the investing section. The investing section is going to involve down here, it's going to involve how the company is getting its capital. And so you're going to be dealing with long-term liabilities, and you're going to be dealing with equity transactions. And so, again, we're trying to identify the transactions that impacted cash. And there's two ways of preparing statement of cash flows. They point out that there's the indirect method and the direct method. The indirect method, the indirect method is one that starts with net income and adjusts net income uh, to its cash basis figure. It's not the preferred method. It is allowed in accordance with United States generally accepted accounting principles, but the preferred method is the direct method. The direct method just looks more closely at the changes. Where did cash come from? Where did it go? So like we'll be looking at cash provided from customers, cash paid out to vendors, and so forth. So it's two different methods for approaching this, but you come up with the same numbers. And really the only difference between the two methods is the differences are only going to show up in the operating section. The financing and the investing sections are going to look exactly the same. And again, the bottom line, the change in cash is the change in cash. It doesn't matter which of the two methods you use. It's more of an end user perspective. The International Accounting Standards Board requires the use of the direct method. GAAP prefers the use of the direct method but doesn't require it, allows for the indirect method, and roughly 98% of US based companies that report using GAAP use the indirect method. And so that is the method that they choose, and that's why you're still learning it. So, how do we proceed? Well, first, we need to start going through this information and identifying, okay, are we going to be doing this from the indirect? Let's do the indirect method first. So we do the indirect method first, and so the first thing you're going to want to start with is net income. So that's going to be at the top of your statement of cash flows, the $60,150. And of course, from that, you're going to need to make adjustments, which will basically help to reconcile net income to the net cash provided by operating activities. And so the easiest one to pick off is usually depreciation. If you remember, depreciation is not a cash transaction. It is a calculation, it's an estimate where we expense items of equipment that were purchased at one point in time, and we're expensing them over a period of time, basically the periods that were benefited. So this $25,500 in depreciation expense that was subtracted from sales did not involve cash. So you would add that amount back to net income to move closer to what the cash basis figure was. The other thing that gets reported in here is the loss on the sale of equipment. If you remember from that chapter, gains and losses are calculations. They are arrived at in using in concert with what the book value and the price or the cash that you receive for an item, but in and of itself, it isn't a cash basis figure. So the loss on the sale of equipment is an item that works to reduce the amount of reported net income, but it's a non-cash item. So you're going to have to add that loss on the sale of plant assets back. Also, the loss on retirement of bonds, same issue. It is a non-cash transaction, and since it's a loss, it is reducing net income. So to get back towards a cash basis figure, you're going to have to add that $825 back into net income. So then what else are we going to have to look for? Well, we're going to be looking at some changes in some accounts. So we're going to look at changes in current assets and current liabilities, because that's what we're concerned about when it comes to the operating section. So the first account we'll look at is accounts receivable. And so we see that accounts receivable changed from 2018 to 2019. Accounts receivable has decreased. Okay, so a decrease in accounts receivable. Remember, accounts receivable are generated at the time a sale is made. And so we basically will we'll recognize a sale by debiting accounts receivable and then crediting sales or sales revenue. And so when receivables decrease, it would indicate that cash was collected. And so in this case, since accounts receivable decreased, that would be something that we would say added to cash. And so we add back to cash the change, which is $5,700. That's the difference between the $39,825 in 2018 and the balance of $34,125 in 2019. We're also going to take a look at the increase in inventory. The increase in inventory was roughly $9,525. So it went from $146,475 to $156,000. So that's the change of $9,525. So inventory is purchased, and we assume, or we're told a lot of times here, what we're told is all inventory purchases are on credit, all sales are on credit. Accounts payable balances result from inventory purchases. So we've got all of these different things here that are going on. So what does the increase in accounts in inventory mean? The increase in inventory is going to be something that we're going to have to subtract from net income. Okay, so the increase in inventory is going to have an effect on net income, and the effect is going to be negative. So we subtract it from net income. So that $9,525 figure that I mentioned would be a subtraction or a reduction. We also have an increase in prepaid expenses. So we went from $1,650 to $3,600, which is a change of $1,950. Prepaid expenses are expenses we pay for in advance that would indicate a use of cash or a cash flow out. And so that would be a subtraction. We would subtract that from our net income figure to move back towards a cash basis item. And then we have a change in our accounts payable. So we come down here to our current liabilities, and we see that our accounts payable has decreased. Well, since accounts payable has decreased, that would indicate that we paid our vendors. And so in paying our vendors, that would be cash, an outflow of cash. And so we decrease accounts payable $4,950, which would mean we'd subtract it from the net income figure. Lastly, the last item here is going to be the change in income taxes payable. And here, the income taxes payable went from $4,425 to $5,100. That represents an increase in the income taxes payable. So that's cash that didn't actually leave. And so we would add that number back. So that $675 we would add back to the net income number. So just to summarize, we started with net income of $60,150. We added back the depreciation expense of $25,500. We added back the loss on the sale of plant assets of $3,300. We added back the loss on the retirement of bonds for $825. Then we looked at the changes in current assets and current liabilities. And we calculated a decrease in accounts receivable that we added back $5,700. There was an increase in the inventory from one year to the next of $9,525 that we subtracted from net income. There was an increase in prepaid expenses. The increase in the prepaid expenses was subtracted, and that was $1,950. And a decrease in accounts payable. The decrease in accounts payable, we subtracted $4,950. And finally, we had an increase in income taxes payable, and we added that figure in for $675. So if we net all those figures, we come up with net cash provided by operations of $79,725. And so we can show that. Let's come down here. This is our indirect method, and we're going to be focusing on the changes up here. So we have our net income from the income statement, and then we show all of our adjustments here. We have our depreciation expense, our loss on the sale of plant assets, our loss on the retirement of bonds. We have the changes in the current assets and current liabilities. We have the decrease in accounts receivable. Notice that the decrease in accounts receivable has the opposite effect of the decrease in accounts payable. So if you're decreasing a current liability, you're going to be subtracting that. If you are increasing a current asset here, if you're decreasing a current asset like you are here, that's an add back. So the decrease in accounts receivable is added back. The increase to inventory is subtracted. Inventory is a current asset, and so the increase in the asset shows up as a reduction to the income number. The increase in prepaid expenses, that's a current asset, shows up as a reduction against the income number. Now the decrease in accounts payable, opposite of the decrease in accounts receivable, okay, that's going to be a reduction instead of an addition. And then the increase in income taxes payable is an addition. And so that's how we get to the $79,725. So what comes next? Well, the next thing we need to look at is the investing section. So what is the cash flow from investing section? Well, we're told in the additional information that we sold a piece of equipment and it had an original cost of $21,375 with a total amount of accumulated depreciation of $11,100. And so I've got my calculator out here. And so I take the $21,375 minus $11,100 in depreciation, and I have a book value of $10,275. Now, the other piece of information that they've given us is here that we had a loss on the sale of equipment of $3,300. So the book value of $10,275, from that I'm going to subtract $3,300. And that means the cash that I received on the sale was $6,975. Again, hopefully you followed me on this. We started here with the equipment cost. This is what we originally recorded the piece of equipment in our accounting records at $21,375. At the date that it was sold, it had an accumulated depreciation amount of $11,100. So we net those two figures to come up with the book value of $10,275. Then we come up and we look and we see that they reported a loss on the sale of equipment. Well, since we know that gain or loss is calculated by taking the whatever it is we got for it, the cash received, okay, the cash received minus the historical value or the book value, okay, historical value minus the accumulated depreciation, which is the book value. So it's that cash received minus that book value is going to equal either a gain or a loss. In this case, it's a loss, which means that the cash received was less than the book value of the asset. By how much? By $3,300. Okay, so consider it as X minus $10,275 equals $3,300. That would be the simple formula that you could use for this. And I see if I can actually write here. So we have X equals, going to have this as 10,000. We're just going to reverse this a little bit. Sorry if it's a little sloppy, but $10,275 minus 3,300. I'm doing this with my mouse, and so you end up with x equaling 6,975. 975. And so that's the cash effect on the sale. Okay? Is it easy peasy lemon squeezy? I don't know. At any rate, so that's how we figure that out. So that's one of the investing activities that we're going to show, is that we have a cash received of $6,975 for the sale of a piece of equipment. Now the other side of this is they also told us that they had equipment purchases are for cash. So we have to come up here and we need to look specifically at the equipment account. We want to take a look at the equipment account right here. Okay. And so what are we doing? We're looking at this change. And so we see that from 2018 to 2019, we had a decrease. Okay. And that decrease in the equipment account balance is $10,875. So then what do we do here? Well, we had the cost of the equipment sold, right, was $21,375 minus the decrease in the equipment account balance of $10,875 means that we had new equipment that was purchased for $10,500. And that's how we end up getting to that change, because the change from here, if you think about it, if you start out with 146,700 minus 21,375 equals 125,325, and then subtract that from 135,825 equals $10,500. So essentially what we did is we started with the 146,700, we subtracted the piece of equipment that we sold, then we looked at the difference between that and the number that's being reported in 2019 of 135,1025, and the difference was $10,500. And so that's the new equipment that was purchased. And so therefore, that was cash paid out. And so the equipment purchases are for cash. And so we show a use of cash of $10,500. And those are the only two transactions that affected our investing activities. And so we started out with the $6,975 of cash received for the sale of the equipment, plus the cash paid for the equipment of $10,500. And so the net cash used in investing activities is $3,525. Okay. I'm going to erase that so that I can go back to, hopefully, there we go. Okay. So I'm going to scroll back down. I'm still learning to use a lot of these tools here. All right, so here's our indirect method, and we look at the cash flows for investing activities, and we see we have the cash received from the sale of equipment, $6,975, and then we have cash paid for equipment of $10,500. And so we have the net cash used in investing activities is a used amount, $3,525. So far we've got our net cash provided by operating activities. We gained $79,725 in cash. We used $3,525 in cash for investing activities. And so then we need to look finally at what did we have going on in terms of our financing activities. And so in the financing activities arena, we want to take a look at it and we say, okay, we had a transaction that occurred. Okay, what was the transaction that occurred here? All right, so we look at a couple of things here and we see, okay, what do we have going on here? We come down and we look, long-term liabilities, bonds payable. Look what happened with bonds payable. Bonds payable was at $37,500 in 2018, For 2019, it's 0. And so something happened there. We had a reduction in our bonds payable. The other thing we see here is that we had a loss on the retirement of the bonds of $825. And so what does that mean for us? Well, that means that we paid out the cash. Remember, this is a liability, so it's money that we owed. So the $37,500 was paid out, plus we had a loss. So we have to add the loss of $825 to the amount that we paid out to satisfy the bond of $37,500. So we get a total of $38,325. So again, that's going to be the difference between the bonds in 2018 and 2019. So it's a decrease of $37,500, which means that we paid that out. In addition, we lost money on that. So that means the cash that went out was greater than the $37,500. By how much? $825. So you add 825 to 37,500 to come up with 38,325. And so that takes care of that transaction. The other thing we look at here is, were there any transactions involving the owners? And so here they say the balance of retained earnings is affected by dividends, dividend declarations, and net income. And so our retained earnings balance did change. It changed from, let's see, we had 108 in 2019 minus 62,100 in the year before. So that ends up being a change of $45,900. So if I take the $62,100 and I add the income reported of $60,150, that gives me a total of $122,250. Okay, $122,250 was too high. That means that there was something that decreased it. They told us the only thing that could be decreasing it would be dividends. So then we take the $122,250, which again was the 2018 balance in retained earnings, plus the net income over here. Okay, that gets us to the $122,250, and then we subtract that. We say minus 108,000 equals So what that means for us is that the dividends declared were $14,250. That's not the end of the story, because if we come up here and we look in the liabilities section, we have the dividends payable. Okay, in 2018, the dividends payable was $4,500. In 2019, it is 0. So you need to take that $14,250 figure and add to that the $4,500 decrease in dividends payable from 2018 to 2019. So I take the $14,250 plus $4,500, and so that means that the cash paid for dividends, okay, was $18,750. So the two sets of transactions that are going to affect cash from financing activities, it's actually going to be cash used. So net cash used in financing activities is going to be the $38,325 for the retirement of the bonds, plus $18,750 for the cash paid for dividends, for a total of $57,075. And so now we have our three categories of numbers that we're working with for the indirect method here. And so we see again, if we come down here, we see the cash paid to retire the bonds, the cash paid for dividends, the net cash used in financing activities. So what was our net increase in cash? It was $19,125. That's the net cash provided by operating activities minus the net cash used in investing activities minus the net cash used in financing activities. Okay, the cash balance at the end of the prior year was $23,925. So to that we add the positive net increase in cash of $19,125, and we come up with a cash balance at the current year end of $43,050. And of course, if you come up to the balance sheet, you're going to see that that is in fact what our cash balance is. So those numbers should tie together. And so now we know that how did cash change? Well, it changed for a number of reasons. They generated positive cash flow from operations, which is a good thing. They retired and replaced some equipment, okay, which generally will use some cash. That's not a bad thing. And here they decreased the amount of debt they have on the books, right? And our investors got a return on their investment. So all in all, we showed net income, positive net income. We also showed an increase in the amount of cash available. The increase in the amount of cash, of course, was different than the amount of net income that was reported. And again, why is that? That's because cash is different than net income. Net income is an accrual-based calculation, whereas the change in cash is the hard, cold cash that we have that we can actually use. And that's why it's important to look at both the income statement and the statement of cash flows together, so you can kind of get a picture of, well, they're reporting X amount for net income. Well, let's go over and see what actually happened with cash as well, so we can see whether, are they reporting net income but yet showing that they're losing cash, or are they building a cash balance? And if they're using cash, what are they using it for? If they're getting cash, where are they getting cash from? We would hope that a mature business would be generating positive cash flow in their operating activities. Okay, so that's what we'd be looking for. And what we want to hope for, if we were to come back here and see that this was a negative number or zero, and that they were generating positive cash flow in either investing or financing activities, we might look at that as being a bit of a problem. Okay, now you're not really responsible for the direct method in this course, and I'm not going to test you on it, but I am going to show it to you just so that you can see the difference between the two. All right, this is the statement of cash flows for the direct method. As you can see, it does not start off with net income. It says cash received from customers, cash paid for inventory, cash paid for the operating expenses, and cash paid for income taxes. So these are your operating activities. But look at the net cash provided by operating activities is the same number we came up with, all right, using the indirect method. However, this method here for showing it is a little more useful to end users, because rather than just adjustments to net income, we're actually seeing the cash figures, what cash went out and what cash came in. Now, how did they determine those numbers? We'll just look at it real briefly, but I'm not going to hold you to it. So if we look at it, the cash received from customers, we had sales of $446,100. To that, we add the decrease in accounts receivable of $5,700. So that means we received from customers $451,800 in cash. Okay, how much did we pay out for inventory? Well, we start with our cost of goods sold number, $222,300. Plus, we had an increase in the inventory, so we show that $9,525. And so that gives us our purchases, okay? The cost of goods sold plus the increase in inventory gives us purchases of $231,825. And then we had a decrease in our accounts payable. And so we add the decrease in the accounts payable, because that meant we paid out cash, of $4,950. So the amount of cash that we paid for inventory during the year was $236,775. And then for our other operating expenses, we showed a balance of $120,300 that was reported on the income statement, plus we had an increase in prepaid expenses. And so we add that increase to the amount already paid for operating expenses. And so we have a total of $122,250 that was paid out for operating expenses. And then what happened finally for the income tax expense? Well, for income taxes, what amount of cash did we pay? We reported income tax expense of $13,725. That would be less the increase in the income taxes payable of $675. So that meant that we actually paid out for income taxes $13,050. Okay. Hopefully you guys followed that. Again, I'm not going to test you on it. If you're an accounting major, you will see this in your intermediate accounting course. I do like the direct method presentation. I think it's a nice presentation relative to the indirect method because, again, it gets to the heart of how much cash was coming in and how much cash was going out, where was it coming from and where was it going to. And so we get a better picture of what's happening inside the business. Now, again, looking at cash flows from investing activities and the cash flows from financing activities, we see no difference between the direct and the indirect methods. And of course, the results do not change. Okay, so that is the statement of cash flows in a nutshell. Again, you are responsible for knowing the indirect method. I will not be testing you on the direct method. If you do have any questions beyond what I've covered here about the statement of cash flows, please be sure to email me and let me know.